Welcome back to this very special chat we are having with Dr. Krishnamurthy Subramanian, the Executive Director at the IMF for India, and of course the former CEA. Dr. Krishnamurthy just laid out how the global economy is panning out. And as you pointed out, Dr. Subramanian, you know, the US may be at the end of rate hikes, but chances of a cut perhaps are not there. As you pointed out, the labour market is showing signs of tightness as well as some giveaway. Now, what does that mean for India? If, as we now see, the dollar is at $105 strong, US 10-year yields are at 4.3, does that also crimp our ability to, you know, cut? And maybe does it even put an upward pressure?
So, you know, Lata, I have actually felt that, especially after the pandemic, India has been able to successfully you know, reduce its dependence or linkage with US. You would recall, you know, our economic policy was very different from the United States. We focused, you know, very much on supply, demand side. We actually, as we just spoke, you know, use the public digital infrastructure to really push on demand. So, reason I'm bringing that up is actually our monetary policy is really catering to factors that India is facing, not as much driven by, you know, by US factors.
No, the only problem is that if the dollar is strong and if US interest rates are high, exporters will not want to bring in the money immediately. Importers will not want to book forward.
No, I think that's...
there is a bit of a impact on exchange rate.
I agree. I think that is actually something that does play out in the short run. But
won't impact policy.
I think primarily India's, you know, and I think monetary policy will be focused primarily on our own inflation front. And here I think if you look at, even though the latest print was 7.4%, large part of that was driven by food inflation, which is something that monetary policy cannot control. And it's primarily, you know, supply side. For instance, vegetable prices, and I think even, you know, oil prices have actually contributed to that, which, you know, monetary policy cannot contribute to that much. So overall, I think, you know, our monetary policy will be driven primarily by our domestic factors. And here I have actually maintained that, you know, unlike in the advanced economies, you know, in India, the part of consumption that is actually sensitive to interest rates is much lower. In India, for instance, you know, you and I will relate, none of us will ever borrow to actually go and eat food or to go on a vacation. We might borrow to actually buy a two-wheeler or a four-wheeler or maybe a house, but that's it. So it's only the durable goods and maybe housing that actually depends on interest rates. So the part of consumption that or consumption demand, because when I talk about demand, I like, you know, separating between consumption demand and investment demand. Consumption demand, I think, is not as interest rate sensitive, but investment demand is very, very interest rate sensitive. And as, you know, I've always argued, you would recall from the 2018-19 economic survey, growth depends on investment through the virtuous cycle. And therefore, investment demand is something that has to be looked at. Overall, so I would see that, you know, that our monetary policy should really be driven by what is happening, even though there are some, you know, sort of considerations that you are bringing in the short run, which I'm not denying, but, you know, from sort of a priority perspective, I think our monetary policy has to be just focused on our own factors.
Yeah, but, you know, there is a El Nino issue that can linger on, and therefore, I mean, rate cuts is difficult, would you say?
So, as I said, I think, you know, overall, if at all there is a possibility that the inflation will continue, I think it may not. If you look at tomato prices, for instance, I was just looking at, I think since 8th of August, they've started declining. Some of these prices...
Cereals are still 13%.
Cereals are still... the one nuance that I will introduce with cereals, though, is especially the bottom of the pyramid is not impacted by cereals because they actually get free food from the PDS. So I think cereals will not have as much of an impact on the budget of the poor. And as we know, inflation is actually a bigger tax on the poor. So cereals, therefore, actually we have to make a distinction versus others. So overall, I will therefore say, because this, you know, any element of inflation that is coming in, it's not as much core, which seems to be quite stable. It is primarily, you know, food and maybe to some extent, maybe oil now, with actually oil sort of being close to $90. And those are not things that monetary policy can do much about. So I would suggest that, we basically continue focusing on giving as much momentum to growth as possible, while, of course, making sure that inflation does not go too much, off the hand.
But what's your estimate of growth itself? Both the budget and the RBI have a forecast of 6.5%.
Yeah.
But then there is this inflationary tax on whatever little bit of consumption, and there is crude. So you think 6.5 now becomes a bit aspirational?
My sense is, yes, if you look at the first quarter numbers, 7.8%, which is very much in the ballpark of expectation. So I should think that 6.5 should be achievable. And, despite some of the global factors that are there, I think we have to keep watching what is happening on the agriculture side. If you look at the latest quarter numbers, growth in agriculture has not been as good this particular quarter. So I think that's something which we have to... but if you look at some of the, private investment that is coming in, I was just looking at the latest monthly economic report that the Ministry of Finance put out. Private investment, I think that is coming in is at a 14-year high. Those are all good things, I think, which will really help. And of course, what was started in 2021 budget, the infrastructure spending is continuing. So overall, I think 6.5% is something we should be able to achieve.
Okay. No, the worry also is that as we get close to elections, the capex, the government may have other uses for money, and also because we're heading towards higher inflation. So will there be more revenue expenditure? And will also private capex hesitate? Like, just let this uncertainty get out. So can we see a slowdown?
So I think that's a good question. My response would be that, if we just see the budgeted capex actually itself is very, is high. And once it's been budgeted, it is essentially for the line ministries to spend that budgeted amounts. And that is something, from my experience in North Block, is essentially monitored by the cabinet secretary, for instance. So my sense is that I think the budgeted capex is something
will not be taken away.
Yeah, will not be taken away for sure. So line ministries have to go and basically spend that. So I don't foresee necessarily, a decline in capex. At the same time, one of the key aspects in the budget was also, incentives to states to spend through the, sort of these loans. And I think that also will hold, because many of the states are, except for I think 2 or 3 which are going into elections, others don't have to cut back on that. So my sense is capex should not get impacted that much. Now, when it comes to inflation, if anything, additional revenue expenditure will only sort of, spur inflation. So that is not a good reason to increase revenue expenditure. So if anything, I would say that revenue expenditure should be maintained as it is, so that inflation does not become a worry. So overall, I think I don't see any reason for us to be pessimistic, on capex.
Okay. Well, now let me come to the larger story. Since you're in the IMF and you're seeing comparative rates of growth, does it look like we are going to be at the 6.5%, 7%, or even a better handle? Because this is our demographic dividend decade. So do you think even 7 will look pale and we'll do better?
So that's a good question. In fact, I just am finishing up a working paper estimating the potential growth for India. I should be putting it up, in maybe a couple of weeks. So where we've estimated the growth for India using... So there's a paper by former Governor C. Rangarajan in the EPW, and they estimate growth using a sort of a disaggregated structural model, across 8 sectors, taking into impact what will be the rate of growth of investment, what will be the productivity changes. Based on that, what we are estimating is that even in so the baseline estimation is, if we do the same rate of growth of investment as we've had over the last 10 years, not the last 20 years, if you would last 10 years, which is a conservative estimate, and if our productivity is the same as the median over the last 20 years, which means basically nothing very different, we should be able to get a growth of 7%. That's the baseline. Now, the pessimistic scenario is where if we actually have, because of global factors and other external factors, let's say investment rate, growth of rate of investment is at the 40th percentile, not the median, and productivity also happens to be at the 40th percentile, then we should be able to get 6% growth. If you're able able to do better. For instance, instead of being at the 40th or the median, we're able to get to the 60th percentile in terms of the rate of growth of investment and productivity as well. We can actually go, close to 8% or beyond as well. So overall, I think the demographics now is something that is a very, very important. In fact, I will go to the extent of saying that the next 20, 25 years, this is an opportunity for India that comes once in a few centuries.
Yes.
Because, we have the opportunity to actually grow and become possibly one of the top 2 economies. And so the next 25 years, India cannot afford to miss. We have to get our policy right, because an opportunity like this comes once in a few centuries.
Okay. I would lean towards 8 because I think we have the demographic dividend and we have a digital dividend as well.
Absolutely. You said it. You said it. Because, I think that is where really, as we spoke about earlier as well, not only can we improve productivity significantly from the digital dividend, but also the infrastructure that we've created that will also enhance productivity. But we can do this in an inclusive manner. And I think that is something which is very important, because when we think about reforms for growth, etc., in earlier times, though, because growth may not have been seen to be inclusive, there may have been headwinds coming from that. But now the technology and the digital public infrastructure can generate inclusive growth and therefore buy-in for reforms on growth as well. So I think that's good news. Again, I'll reiterate, the next 25 years are really critical for India. Once in a opportunity, once in a few centuries opportunity for us to really spear ahead.
So the key headline for me from what you have said is that the next 25 years are critical, but I think the bigger headline for me is that we should do at 8%. And I think I have you on my side, or I'm on your side. Well, on that optimistic note, we wrap up this very interesting chat with the former CEA, Dr. Subramanian, now IMF ED. Thank you very much, Subramanian, for dropping in.
My pleasure, Lata.